here. And okay, we can now minimize when we're going live. Okay. Yes, sharing your platform. Okay. Okay. This is preparing live stream. Okay. Okay. And of course, feel free to share this on your wall once we're done, or even as we're, I think, if you're able to share while we're live. Tell us when we're live. If it says live in there, we may already be live. Okay, awesome. Okay, hey, okay. Hey everybody, Leticia here, or Leticia, coming to you today for another edition of my weekly Money Matters webinars. And today's topic, as announced a little bit earlier today, is RRSP eligible real estate investing. And I just realized I have, give me 1 second, guys. Yeah, a little distraction in the background there. Okay, and as you may recall, last week's topic was commercial real estate investing, and that is for people who are looking to become active commercial real estate investing. And as our guest last week explained, there is a learning curve involved with that, as you can imagine. So today's guest, our friend David, thank you, David, for joining us again today.
Thanks for having me, Leticia. It's nice to be back.
My pleasure, my pleasure. Grateful you could join us. David has been our guest before, David Grossman. He's an experienced Ontario-based mortgage broker. And as of about a year, David has also become what's known as an exempt market dealer. An exempt market dealer is a designation, or rather a license, offered to licensed representatives by the OAC, by the Ontario Securities Commission. And people like David are licensed to offer Ontarians certain types of alternative investments. And we're going to explain what that is. And one of these alternative investments has to do with giving people like you and I, ordinary Canadians, access to these sort of commercial real estate investing projects. However, as you're gonna soon find out, you don't require millions of dollars up front, not even hundreds of thousands of dollars up front. And you also bypass that rather steep learning curve that would otherwise be required to actually get started with commercial real estate investing as an active investor. So of course, there's many things you could do with your money and many investment options. My intention with the webinars is to present you with those options, and then you can see what is more a fit for you, okay? And I definitely think that, you know, in my experience, people, when, especially when it comes to their RRSPs, their TFSAs, in terms of what you can access at a bank, which is where most people go for their investing, you are a little bit limited in what you have access to. Banks will offer you mutual funds, they will offer you GICs, and that's about it in terms of what you can actually put your money in. And as it turns out, there's another world out there that you would need someone like David in order to access. There's the world of alternative investments. And so today we will speak about a certain type of alternative investment. I'm gonna actually let David take it from here, and he'll be better able to explain everything.
Okay, thank you very much, Leticia, and thanks for having me back on your show today. Love your podcast. I think it's great what you're doing. Love to see some of your videos in Playa del Carmen. You know, I'm probably not. It's not only me who's got to say, like when I'm looking outside at a foot of snow here in Wasaga Beach, that I'm jealous when I see you at the beach and things like that. So,
well, thank you, David.
So good.
Wasaga is a beautiful place too. So at least you made the move out of the GTA to cottage country.
We're very happy to be out of the concrete jungle and looking forward to the spring, because it'll be very nice here, I'm sure.
Absolutely.
In the spring and the summer. So just a couple of things. Yes, the license, my designation is dealing representative, and I'm
Okay,
employed by an investment firm who are an exempt market dealer.
got it.
And this they sell. So first of all, maybe I should start with what is an exempt market product, like
Yes,
why?
please,
Okay,
please go ahead.
so an exempt market is an investment that is not sold on over-the-counter exchange or on a stock exchange. So that's why it's called sometimes private equity, is because it's not available on the public exchange. So the companies that offer this, they don't have to meet the same threshold in terms of reporting, and it's also very expensive to be able to have yourself listed on the exchange. So there's a lot of overhead and a lot of extra cost involved. For a smaller company, sometimes it just doesn't pay. So there are these investments around, and some of them are good and some of them are less good. But Huxton Black is a very cautious investment firm, and the products that we have on our shelf have been very carefully vetted. And the one that we want to talk about today is Pulis Investments. And I also want to mention, because I know you talked about commercial real estate, and normally sometimes commercial could mean different things, but I think it's important to point out today that we are talking about a 100% residential product. It's multi-residential, so the
Yeah,
firm is going out and buying small apartment buildings, typically 20 to 30 units in size. There's a niche market there they tends to be ignored. The larger companies that are looking to acquire assets typically look for 100 unit or greater. So there's a kind of a niche market, and that's the area that Pulis plays in. It's a fund that and a company that's run by father and son. Kyle Pulis is the son, and the father's Brian Pulis. They've been doing this for about 20 years. So why don't I
yeah,
bring up
and
now? It says I'm disabled from
yeah.
sharing.
So while you do that, David, I do want to just share a brief comment. This is, as some of you know, I have, I was, I was attending a lot of real estate investing events when I was in Ontario, and I've definitely heard of Police Investments, and I've actually met the owner, and they are, you could say, they are legends on the Ontario real estate investing scene. This gentleman, again, as David mentioned, they have been active investors. At least the father started a company more than 20 years ago. The fund itself that David will speak about was started about 10 years ago. Now, keep in mind, one of the reasons we're even discussing this right now as a possibility for ordinary investors is because as of only a few short years ago, I'd like to think it was 2017, maybe even after that, Ontario changed the regulations and allowed ordinary investors to have access to this sort of investment. Previously, you had to be what's known as an accredited investor to even be able to invest in this sort of opportunity. And David will have a slide for us later on that explains sort of, what's an accredited investor and where you need to be in order to even be able to access this, sort of, there are some restrictions for everyone's protection, but those restrictions have been lowered significantly since Ontario changed the legislation a few short years ago. So yeah, so that's all I wanted to say about Pulis and about this type of investment. So David can take it from there.
Okay, thanks very much, Letitia. So the firm, as we said, is about 20 years old that they've been doing this. Brian Pulis is the founder, so they started in 2002, buying up apartment buildings. The area that they operate in is mainly in the Hamilton area, which we all know is a very good market and a very hot market. It's been going up and up. And as we mentioned earlier, I think it bears repeating that the space that they're operating in is 100% residential. And this is very important because at this point in time, I think there's, question mark around a lot of commercial real estate at this point in time, because due to COVID, you just don't know what's going on now. If you're a plaza and you have some great anchor tenants, LCBO, Shoppers Drug Mart, and shopping Sobeys or what have you. That's one thing, but if not, there's a real question mark. So, even in times of COVID, people need a place to live. People need a roof over their head, and the first thing that people pay, no matter whether it's a good market or bad market, the first thing they're going to do is pay to keep a roof over their head. So that's why it's perceived to be a good sort of a niche market.
Very good. And yeah, like, sorry, David, for interrupting. I know I'm a big fan of multifamily investing in general. Apartment buildings are an asset that has proven its worth over the course of time. Like, these are typically properties that get passed, from generation to generation. We're really talking about potentially multi-generational wealth. They perform really well even in down markets because, as David stated, even in the worst of times, people still want to keep that roof over their head. And in fact, perhaps, David, you are better informed as to how these assets have performed even in these more challenging times that we're going through as a societal level.
Well, I mean, Pulis isn't the only REIT, so it's a real estate investment trust, and it's not the only one that we offer, but it is one that we do like. And we have always been really leaning towards the multi-residential because, like you said, good times and bad times, people need a place, a roof over their head. So the Pulis model is really one where they are going in and they've constantly got their feet on the ground looking for good deals. They have found that when you're looking at apartment buildings that are under 100 units in size, they're basically a lot of them are owned by just families, and they're not very sophisticated managers. So what happens is sometimes the buildings in some cases, could be neglected. Opportunities to maybe turn over tenants may not have been maximized, and we all know there's rent control. So you really have to know your game if this is a game you're going to work in or play in, so to speak. So the Pulises, they look for buildings that kind of fit that model, that maybe they see a lot of potential upside. A lot of the times they'll go in, they'll manage to renovate units, they'll manage to find ways to turn tenants over and really increase the rents. A typical apartment unit would be one, let's say, that's renting for about $800 a month. They go in, somehow convince the tenant to leave. They pay him off or whatever, and they put about $30,000 worth of renovations into the unit, and then they then they rent it out to a new tenant for about $1,500 a month. And so that represents a very dramatic increase in the value of the property, because commercial real estate, that's how it's valued, right? And again, when we're talking about commercial, we're talking about multi-residential. In this particular case, it's based on cash flow. That is the main factor. So increasing the rents that much has a dramatic impact on the value of the building. So they'll go in, they'll turn over tenants, do some renovations, and improve the rents, and then refinance, take out equity, and do it all over again. And that's a model that a number of people follow in this business. But as you said earlier, it's not something that you can just do part-time. I mean, it's great for people who want to learn about real estate and go out and try and do things, all the credit to them. But if you're focused on your own life and your own business, and you don't have the time or the money to make a lot of mistakes, you want to be putting your money with people who have some expertise in a particular area, well, this is one of the companies that has the expertise and has performed. The returns that people tend to receive over the years with this particular investment is typically around 9%. Okay, it's a combination of return on capital and also appreciation. So the value, because the value of the portfolio is constantly going up, so the units that you own are constantly going up. So at the end of the day, people tend to be receiving a return of approximately 9%. It is all tax preferred. There's an ongoing return on capital of 6% per year. So that's 1.5% per quarter is paid, and it's paid as a return on capital. So it is tax preferred, let's say, in comparison with interest income.
Right.
And then so the appreciation as well as the unit prices grow and the portfolio grows, that is also tax preferred. So they're treated as capital gains when you eventually sell. So it's deferred and it's preferred. And that's how they've been operating.
Which, by the way, David, so just so people understand what that means and why that's important is, okay, if you choose to participate in this sort of investment inside your RRSP or TFSA, which is already a tax shelter vehicle, that the type of return you get may not matter to you much because it grows on a tax sheltered basis. However, for those of you who maybe are not fans of RRSPs, or they have money sitting in cash at the bank or in a non-registered portfolio of the bank, because we all know there's only so much the government will allow you to stash inside an RRSP or a TFSA. And maybe for those of you who do have extra resources, you're looking for places that are tax efficient to put your money. What David is describing is a very tax efficient return or way of you to get your return on investment with this type of investment. And it's the most tax efficient, called return of capital. And in addition to that, capital gains, which again are taxed at a preferential rate. And if you contrast that, for example, with a mortgage investment pays you a fixed interest rate, or a GAC, for example, not to mention GACs pay nothing these days. But anyway, that is interest income. Interest income, if it's outside of a tax shelter vehicle, it will be taxed at your full marginal tax rate. It's fully taxable. I hope that makes sense. And I just wanted to kind of explain why David is even talking about this. Okay.
Yeah, it's a good point, Letitia, and I think it's also worth mentioning because you touched on it, and that is that a lot of people they just invest with mutual funds through their bank. Those funds, the performance of them is often not great. The fees are very high. And people don't know that there's alternatives. And we would never suggest that somebody put all their money into one particular investment. Everybody needs to have some level of diversification, but there's no reason why somebody couldn't have, let's say, 20 or 25% of their overall portfolio into private investments like this. A little bit higher risk than your typical stock market or a stock, but
I don't really see it as higher risk, David, to be honest. I mean, I don't see it as higher risk because with a stock, especially if you're starting to do I mean, listen, we had a guest before talking about self-directed stock investing. We all know that if you're new at that, you're not going to take your entire RSP portfolio and start, playing the market. You might want to start with a small piece and do some of that. There's no reason you shouldn't do that. But if we're talking about, let's say, a diversified mutual fund portfolio, which is what most people have at the bank, we've all seen what happened to the markets in 2008. And right now we're in a time where a couple of things are happening. There's a lot of money printing by the central banks, which has created, unfortunately, and I'm not the only one talking about this, we're seeing what I believe is an artificially inflated stock market, because all the, some of that stimulus money that's been given to Canadians or Americans and has gone into the markets. Let's not kid ourselves. But is there really value there? Are those stocks really worth as much? So you're actually, in my opinion, at quite a high risk as to, whatever kind of diversified portfolio you may be in. This is a generic thing that's happened. All this extra paper money has gone into the market. Is it truly a reflection of what those companies are really worth? Big question mark, right? So I expect, and I'm not the only one saying this, that there's going to be a correction overall in the stock market. So you can stay in the market and think, yeah, okay, well, it's not going to happen to me. 2008 was not going to happen. A lot of people were not prepared for what happened in 2008. We all saw what happened. So if you think that by having just a diversified stock portfolio, that's going to protect your money, I would say maybe think twice, okay, and maybe think about some other things you can do to your money to protect yourself, at least protect
Yes,
yourself and potentially get a higher return on your money.
you make some very, very good points, Letitia. Those are very good points.
Thanks for
Um,
hearing me out.
yeah. Absolutely. So this is what I was relating to earlier. This particular slide talks about their target being 100 units and below, because that's a kind of a neglected area with a lot of ma and pa investors and a lot of upside potential for somebody who has some expertise in knowing how to improve the value of those buildings. They do a lot of the work themselves, the property management. That's where their expertise is, and they bring in the right people to do the renovations, and they've been doing a great job. They've got, actually right now their portfolio is a total of 9 buildings.
Okay.
They have a total of 9 buildings right now.
That's more than most of us. That's
Right.
more than most of us, I'd like to think. I know there are in my network a number of successful investors, but definitely,
Right.
yeah.
Right. And and in terms of registered funds, anything that is registered can be invested. So whether it's RRSPs, LIRAs, TFSAs, RESPs, LIFs, RIFs, I mean, whatever it is. And we usually use Olympia Trust for that. So if people have RRSPs and they want to look at moving some of them into something like this, then what they would do is they would convert, if they're holding certain investments, they would convert those into cash, and we would make arrangements for them to move that money over, transfer in kind. So it doesn't come out of the RSP. That's a frequent question. People are worried, oh, if I'm cashing my or selling some of my mutual fund, is it coming out of my RSP? And no, it's not. It's just being moved over to a different trustee, Olympia Trust, to hold it, and then the shares or the units of Pulis can be purchased that way.
And just so people know, I'm sure most of you know by now, but you can have multiple RSP accounts. So even if, let's say, you have a $50,000 RSP portfolio, whatever amount you may have at the bank, if you were to take advantage of this sort of offering, such as David is going to be speaking to us about, you don't have to transfer the entire amount. In fact, David will tell us what the minimums are, but you could literally take a portion of your portfolio for the sake of truly a different type of diversification. And if you'd like to take advantage, so you could have an RSP account still at the bank, an RSP account still now with Olympia Trust, which will facilitate your purchase of the Pulis REIT in this case.
That's correct. And the minimum investment is around $5,000.
Which I'm sure you'll all agree is quite reasonable for accessing. Well, you'll first of all see what David will show you.
Yeah, I mean, it's quite reasonable because, as you noted at the beginning, like until a few years ago, Letitia, there were some real restrictions around what it would take to get into something like this. And the rules changed in Ontario, and I think some of the other provinces as well. And there's various different classifications of investors. You have accredited investors, you have eligible investors, and then you have non-eligible. And we'll get into, there's a slide that we'll get into that talks about the nitty gritty.
No, David, I know you had a little video you wanted to show us before we.
Sure. So let's do the video.
Okay. Are you sharing the computer audio as well? Yeah.
Real estate has always been a cornerstone of successful wealth accumulation, and multifamily properties are a favored category among savvy investors. Aligning yourself with experts in this industry maximizes your investment opportunity for exceptional returns. Welcome to Polis Investments. How does Polis reduce the risk? Polis investors participate through a strategic, diversified pool structure that allows your money to be pooled with other investors. Polis allocates this pool of funds in a highly tactical and diversified manner, reducing risk and increasing investment stability. Polis is highly aligned with investor interests, offering 93% profit sharing, low management fees, and in-house professionals that keep expenses in check, renovation progress on schedule, and a steady stream of new rental tenants in line. What is so attractive about the Polis approach? The Polis strategy targets double-digit returns through its niche focus of purchasing undermanaged and undervalued mid-sized rental properties. The acquisition of properties with such unrealized potential in cities with attractive real estate opportunities allows Polis to capitalize on an underserved and less competitive sector within its industry, and to maximize the potential for increased property values by implementing strategic renovations which transform buildings and units into highly desirable living spaces. For example, economic trends identify Hamilton, Ontario, located just outside of Toronto, as among the fastest growing cities in Canada. Led by a downtown revival of culture, dining, and arts, Hamilton is undergoing economic revitalization, creating new opportunities for young professionals in key industries. This entrepreneurial culture is leading to a surge in occupancy rates and increasing real estate rental values. How does Polis save you time and make investments less stressful? Investors prefer to avoid the stress that comes with trying to identify, secure, and manage the right real estate investments. With Polis, you get the necessary experience, expertise, and resources to handle every aspect of your investment, and they get your money working for you. There is nothing else you need to do. No worries, no hassles.
Our strategy is really what sets us apart from other investment companies. We like to look for young professionals as our ideal tenant profile, a city that is experiencing above average growth, and looking for a property that has unrealized potential.
In this real estate investing industry, there's all kinds of players out there. Who do you trust? Well, I trust Polis. Why do I trust Polis? It's all about integrity. It's all about their knowledge, and it's all about their experience.
We're a family business with decades of combined experience. We've been recognized for excellence over the years, and we've been presented with many awards, one being the Michael Milner Award for leadership, and the other that Kyle was awarded in 2013 for Multifamily Investor of the Year.
With Polis, you get focus, you get integrity, and you get commitment.
Why has Polis placed Hamilton among its prime investment targets?
Hamilton's a terrific city. It's rapidly growing economically. It's got a very progressive and focused municipal government, as well as it being situated close to Toronto and the US border, make it perfectly poised to grow.
It is said that the best investors are always making moves ahead of the curve. With Polis's combination of sound logistical strategies and proven methods, the time is now to ask your registered investment advisor if becoming a part of the growing success at Polis Investments is right for you.
Thanks, David. So you can stop the screen share. Well, maybe don't stop it yet.
You want to see the other slide? This
Yes,
one here?
let's talk about that, and then we're gonna maybe sum it up just for people to get a better idea. Yeah.
Sure. Okay, so an eligible investor is somebody who has a total net worth of $400,000, or they make at least $75,000 a year on their own, or $125,000 combined with a spouse. The maximum amount of money that an eligible investor can purchase is $100,000. into any private equity or investment through an exempt market dealer. And the next category is, well, actually, we'll skip down to the bottom. This is the accredited investor. So there's, with an accredited investor must have a net worth of at least 5 million. That's how we define them. Or they have financial assets, so not including real estate, of at least $1 million. And if they meet that criteria, and there's also an income threshold of 200,000 per year. If they meet that criteria, there's no limit on how much they can invest. And if somebody does not meet the criteria of the eligible investor, then they can invest a maximum of $10,000.
Right. So I just
Okay.
wanted to again restate, David, that previously only accredited investors were allowed to invest in this sort of product. The rest of the people, which is the majority of the Canadian population, you were pretty much stuck with whatever the bank would offer you, or perhaps insurance companies. But I mean, you were in the realm of traditional investments only. Okay. Whereas now, a good number of Canadians, even those who are non-eligible investors, could at least invest up to $10,000 in this sort of a project, okay, with a minimum of 5,000, as you stated, David. So maybe you could just sum it up for us, David. So with this sort of investment, the benefit is that people get to participate in apartment building investing without having to go out there, identify the properties themselves, do all the work to rehabilitate these properties, improve the value. They literally get to participate in the returns of an already successful company that's been doing this for over 20 years, well, roughly 20 years, okay? And then what? They get predictable returns.
Yeah.
You know?
I mean, the returns are not guaranteed, but that's their target, and that's what they've been hitting. So they've had a very good track record. They know what they're doing. It's a great way for people to diversify. I mean, we typically don't, usually go out there and lead with product. We want to help people find the right solution for them. We have a responsibility to do that, to make sure people are diversified, people understand what they're getting into. But people do like real estate. They understand real estate. They're curious about it. And if, as we said at the beginning of the call, if you don't have the time to become an expert, it could be very expensive. So find people who you know or can learn to know and trust, and invest with them, and increase your overall returns, diversify, and find out what options are available. Because, like we said earlier, keeping all your money parked at the bank, and especially if it's in the stock market, that I agree with what you said was a very good observation. I do think it is artificially inflated now, and the underlying values are not there. So, there's a lot of risk and exposure there, and it's definitely a good idea to be diversified, especially if you can increase your overall return and performance.
Of course, David. David, do us a favor. I don't know, we covered everything pretty fast. Is there anything else that they'd like to share, whether about this type of investment? What kind of people do you see, first of all, taking advantage of this type of opportunity, David?
Well, I mean, I think that it's for me, you've got to be living in Ontario, right? But
Right.
I do think the company offers investments for anyone across Canada.
Mhm.
But I'm licensed to operate in Ontario. I think that anybody who is looking for some kind of diversification, anyone who wants to improve the overall performance of their portfolio, should be looking at this type of thing. I wouldn't mind sharing my phone number.
Oh, no, I was just going to suggest, David, please put up your contact information.
Okay.
And as you can see, everyone, David is super approachable, easy to work with person. I've had the pleasure of working with David for, at least a couple of years now, referring clients. You know what, David? You're better off sharing your slide
Oh yeah, okay, that's a good point.
for everyone to see, because only a handful of people may see it on Zoom, but I know a few people will get to watch this live on Facebook, whether live or right now or later. Yeah, maybe make that. Okay, there you go. Absolutely. So everyone, should you be curious and want to know more about the specifics and how it all works, David will be happy to explain that to you and, you know, and assist you with the process.
And please let me know if you heard about me through Letitia, because you'll receive a special gift. And we'd like to know, because Letitia's doing a great job educating her clients and database. So thanks for the opportunity, Letitia, to be on your show. I think you're doing a great job.
My pleasure, David. I really appreciate that. It's been a pleasure for me running this webinar series, and I've gotten quite a bit of positive feedback, and it's always a pleasure having you as a guest, David. And I know you're up to a lot of good stuff for your clients, and I look forward to having you back in the future. And,
thanks. Look forward to seeing you again one of these days. If we're going to have to make it down to Playa next winter, that's my goal.
That would be fantastic, David. Let me just see, David, if there were any questions. Feel free to, you can leave the screen up, but I'm going to see if I can just check on Facebook to see if there were any questions. Sometimes people put questions in the comment section. Okay. I don't see any questions, David, but if anybody does ask any questions later, I will let you know. And feel free to share this on your Facebook wall as well.
Yeah, I did already. So it's on mine, and it's on a different group too. So.
Oh, you rock. Okay, yeah. Amazing. Okay. Amazing. Thank you very much. Thanks again for joining us, and thanks everyone for watching. Have a great rest of the week, and we'll see you next week. Okay.
Bye, everyone. Bye, Letitia. Thank you.
Take care. My pleasure.
Take care. Bye.